We're going to look at Realty Income, and I'm going to walk you through the process of valuing a company. We're going to actually enter the financial information into the model. I'll show you where to get it. Then the model will estimate the future free cash flows of the company, and we're going to figure out the discount rate we need to apply to those cash flows, and the model will present value those numbers back to today's value. And that's how we get the intrinsic stock price of a company. And we're going to compare it to the actual stock price to see if it's a buy or a sell. And then last, we're going to look at financial ratios and compare them to similar REITs. So the first step, we'll get the market cap, which is 21.3 billion. So it's a good sized company. And we enter the stock price, 62.21. So if you want to figure out the shares outstanding, it's just a market cap divided by the stock price. That gives you the shares outstanding, 342 million. And we need that number because when we figure out the intrinsic value of the company, we have to divide it by the 342 million shares. Now let's get the free cash flows from Yahoo Finance. We'll go to the cash flow section and we'll just copy and paste the last 4 years of free cash flow. And I added some notes to clarify some things. So if you wanted to calculate free cash flows, you can just go to the cash flow statement and then look at operating cash flow and then subtract capital expenditures. So when this number is positive, that means the company is adding value to the firm. It's increasing their assets. And when it's negative, it's reducing value to the firm. So this is the most important thing when valuing a business, free cash flow, because after you run your business, you want to see the cash remaining. Just imagine you were buying a company from someone. It could be think of a small company. It's much easier to visualize a small company without so many moving parts like a big entity like this. So if you were buying a small business, you would just ask the owner or the person selling it to you, how much does a business make? How much am I going to put in my pocket after I pay my employees and my expenses? And the owner says, $150,000 is how much I take home after all my expenses. So that's pretty much the value of a small business, is usually how much it makes in 1 year, because that's what you want to know. Same thing with a large business. You want to know how much it makes, the cash flows, and that's what free cash flow is, the cash that's remaining after operating the business. Net income doesn't give you that number, but we do need it for the model. We call net income the profit and loss, but net income has a lot of other things involved in it, which can make it a little confusing to look at as the end-all be-all for how much a company's worth. Because there's a lot of non-cash items in net income, such as depreciation. If you buy a building for $100 million, you may depreciate that for $10 million every year. So depreciation is an expense. So every year you're going to deduct $10 million on your income statement. So in like 5, 6, 7 years from now, you look at the income statement and you see there's a loss. And then you think, oh my God, we lost $1 million. And then I would say to you, no, we made $9 million in cash, because that $10 million is not actual cash, that's depreciation. And then last, we're going to look at revenue. And that's just the sales for a given time frame. And that's the most straightforward number. It's just the actual sales from the business. And now the model calculated the future free cash flows. That's already set up in the model. But we need to know how to discount those cash flows. Just like if you were getting a mortgage, the lender would need to know your credit to figure out what interest rate to charge. So we need to figure out what interest rate we need to charge this business to figure out what those cash flows are worth. Because if it's a risky business, we need to give them a really high interest rate, like a 10% rate to discount the cash flows. But if it's not a risky business, then we could give them a lower rate, like 4%. And the lower the rate, the more conservative the results are. So I put in the interest expense, which is the interest this company pays on its debt. And now I need to see how much debt they have. So we'll go to the balance sheet and go to the liabilities section. They have no current debt. They have $7 billion of long-term debt. So they pay 3.5% interest on the debt. So the discount rate is a combination of how much you pay for equity and how much you pay for debt. Pretty much how you finance the business. Like your home, you financed it through the bank. The bank gave you the money to get the home. Now for this business to operate, they need cash. And that's through debt and equity. Their regular sales are cash, but that's more to operate the day-to-day operations. I'm talking about to get started and to make large purchases, you need to either sell your business, which is equity, selling shares to the market, or sell debt, bonds to the market, and then you have to owe them that money back in the future. Let's look at the beta, because we need to figure out the volatility of the stock. Because if it's a really volatile stock, the CAPM, capital asset pricing model, would be high. This is a low beta, it's under 1, so the price of stock doesn't move nearly as much as the market moves. So that's a good thing. That means it's more safer of a company to invest in. Because you don't want a company that stock is all over the place, like these penny stocks people keep talking about, because you could make a lot of money or you could lose a lot of money. That's called gambling. It's not really called investing. So the cost of equity is only 7.3%. See, if the beta was 2, that would be a really volatile stock, and we'd have to charge them 18% when we gave them money. But since it's a low volatile stock, we don't have to charge them as much money. It's only 7.3%. So the cost of equity is 7.3%. The cost of debt is 3.5%. So when you combine these numbers together, you get the weighted average cost of capital, which is the discount rate we need to apply to the future cash flows. That's what I was talking about earlier. When you get a mortgage, your rate is based on your credit. So they have good credit because they have a low WAC. I've done companies that had a WAC of 15%, so they have to really pay a lot of money to get financing. So 6.28%. We're going to apply that to the future cash flows. And we estimated free cash flows for 4 years. And then we do a terminal value, which is all years past year 4. And then we discounted those numbers using the weighted average cost of capital back to today's dollar amounts. And then we have a value of the company of $19 billion. And we take that number, we divide it by the number of shares outstanding, which is 342 million, and we get an intrinsic stock price of $57, which is really close to the actual stock price. And when I started this discounted cash flow model, started the channel, I had a really hard time valuing REITs because they're much more complicated than a regular company, because REITs pay 90% of their profits out as dividends. So that you have to take that into account. So it's a kind of a different animal. But my last several REITs that I put through the model, it seems like the results are really good. So I feel good about the valuation. But anything can change in the future. Taxes can change. That's why the model is constantly changing. Let's look at the historical stock price. So it's at $62. And it looks like it was trading in the low to mid 70s, or maybe even touched 80 for a few months back, but it's been pretty steady around $60. So it is trading at around intrinsic value. According to the model, it's a sell. It's trading at a 9% premium, but that's really close. When you ever go to companies' websites like Goldman Sachs or JP Morgan, an analyst might say I'm rating this company a buy, and another analyst may say, I'm rating this company as a sell. The way they do that is they run a discounted cash flow model and then identify if it's a buy or sell. They also look at ratios too, which is what we're going to do right now. And first we need to go to the balance sheet to get a little more info. I could do this before the video, but I think it's good that you can see where I'm getting this information from, because I think you learn a lot more than if I just put it in the model and didn't talk about it. So current assets is $500 million. Current liabilities is $227 million. And equity is $9.8 billion. So current assets is cash, accounts receivable, and inventory. You can think of it as assets that you can convert to cash pretty easily, because this is what you need to run your day-to-day operations. You can't really run a business unless you have current assets. You might have non-current assets like a building, equipment, and those are valuable too, but you can't just convert it to cash right away. It might take 6 months, a year, 2 years to get that into cash, especially like a building or real estate. So current liabilities are short-term liabilities that are due within 12 months. It's usually accounts payable and short-term debt. So accounts payable is when you buy something on credit. So you buy products from a supplier of yours, and they give you 60 days to pay. So now you have to post something to your accounts payable. You owe them $1 million. And this is a good way to manage your cash, because certain businesses can't just pay everything in cash because they need to pay their employees and they need to pay their rent. So they have to buy on credit so they can manage their cash flows and not go into default if they miss an interest payment on their debt. Let's look at their financial ratios. This is what a lot of people do to value a company. They look at the ratios, and you could just in Yahoo Finance you can easily find their ratios, or you can just Google PE ratio for Apple, PE ratio for this company, and you'll probably find it. So PE ratio, I generally look for under 15, but if it's over 15, I will look at other ratios to make my decision. But this is a really high PE ratio. It's price of the stock over earnings per share. So this means investors are willing to pay $49 for $1 profit. It doesn't sound so great, and it could indicate it's an overvalued company. So if the stock price comes down, then the earnings stay the same until the next earnings report. But if the stock price tomorrow got cut in half, that PE would go from 48 to 24. So it would look a lot more attractive if the stock price went down. Or if the company bought back stock, they can also lower the PE ratio. And the good thing about PE ratio, it kind of standardizes the numbers. So you can look at like a $1 billion company against a $1 million company, and with the PE ratio, it kind of makes it the same, and then you can kind of compare. Price to sales ratio is the stock price over the sales per share. And I like to see under 2.2 for this. And also the lower the better. And if it's high, it could be an overvalued stock. So far, it's not looking so great. Their ratios aren't so good. Price to book, they have a good price to book. And I think almost all REITs have a solid price to book ratio. This is the stock price over the book value. And the book value is your equity. Equity is your liability, your assets minus liabilities. So it's on your balance sheet. It's the value of your company according to your balance sheet. So you could never take a number and say, okay, it's low, therefore it's good, it's high, therefore it's bad, or vice versa. You have to look at the number, then maybe look at other factors as well. Current ratio, I like to see between 1.2 and 2. This is the liquidity to run your day-to-day operations. So this is a good ratio. They have enough cash on hand to run the business. And ROE, I like to see over 20%. They only have 4%, but it seems like most REITs have a pretty low ROE. That's your net income over your equity. Remember, equity is on your balance sheet. It's your assets minus liabilities. It's the value of your company. And always compare to similar companies in the same sector, because you really don't know where a company lies. You might say, "Oh my God, that's a good current ratio. That's a bad PE ratio." But then if you compare it to their competitors and say, "Oh, that's not actually that good," and "Oh, that's not actually that bad," that's how you really know. Some industries just have worse ratios than others. Just the nature of the industry. So we're comparing the PE, price to sales, price to book, current ratio, ROE, and debt with all the REITs that I looked at. So I looked at 8 REITs since doing these videos. So all this data is just pulled in automatically. I don't have to really do anything. So it makes it kind of convenient. And the ones in orange are the winners in that category, who have the best ratios. And we're doing this company right here in the middle, Realty. And it's not the winner in any category. That doesn't mean it's bad. It does have a bad PE, like AMT and BHR have bad PEs. A few seem to have pretty good PEs, a few REITs. And it doesn't have a good price to sales. It's an okay price to book. It's under 3, so that's a good price to book. But it seems like REITs have really low price to book, so I'm not sure why that is, but it's just how REITs are. It has a really good current ratio. I wouldn't want a really high current ratio. 3.6 is okay, but once you get too high, that just means you're sitting on a lot of cash, and it's probably better uses of cash than just to leave it on your balance sheet. They have a terrible ROE, and their debt is good. AMT has the lowest debt. They have 27% debt. As long as it's under 50%, because you never know if something's going to happen like coronavirus and business is going to struggle and you're going to need to borrow money. And if you're like some of these companies with 90% debt, you might not be able to borrow, and then you have to pay interest on your debt. And then if you can't pay the interest, you are forced into default, which is really bad, because then you're a stockholder and you may get nothing. So this is the analysis on Realty, and let me know what you think in the comments. And I hope I help you provide more color on this company and the entire industry. And thanks for watching.